Assalamu alaikum. So, as we have discussed our first four chapters of financial accounting, so now we are moving towards our next part, which is the fifth chapter of this financial accounting. So, in this chapter, we are going to present the reporting of financial results, and we will focus on the purpose of this reporting of financial results, and we will also present the disclosure of financial statements. So first of all, we are going to understand the purpose of these financial statements. As these financial statements determine a lot of importance for for discovering the performance of different people inside the company. It can be employees, it can be the executives of the offices or businesses, that how they are working, and what is their outcomes in the company. And the other purpose of preparing these financial statements is the aid in decision making. So after using these statements, the investors, stakeholders, creditors, and the management take a lot of decisions which are to enhance the different departments of their businesses, or to move forward, or following different trends in the markets. And it can also ensure the transparency and accountability. So using these financial statements, it can foster the trust and transparency by providing a reliable and accurate picture of a company's financial position. So these are all the purposes of reporting the financial statements, and then we are going to prepare different statements which are being used. So the very first is the income statement. As we know that the major parts of the income statements are revenue and expenses. And when we eliminate these expenses from the revenue that the business has earned, we get the net income. So the revenues are all those amounts or money that they have generated from their operating activities. And the expenses are all those costs which are incurred in the process of generating revenue. So the revenue comes from the sale of different products, or by providing the services to the different clients or customers. So for determining the net income, we eliminate all the expenses, like the cost of goods sold are being eliminated from the revenue or the sales that we have made, which gives us the gross profit. And after that, we move next. We calculate different operating expenses which are incurred in earning the revenue. These all expenses are then being eliminated from the gross profit, which gives us the income before income taxes and interest. After that, the interest is being paid, which is payable by the company. It gives us the income before taxes, and then the taxes which are implemented by the government on the different companies and organizations. These taxes are then being deducted from that amount, which gives us the net income. This net income shows the that whether the company is in profit or in loss. So the next statement which can be prepared is the balance sheet. So where the major components of the balance sheet are assets, which are equal to the liabilities plus owner equity. As we know that the assets are the resources owned by the company, like the cash, inventory, supplies, accounts receivables, land, building. And the liabilities are those which are owned by the company to others, like the creditors and accounts payable, wages payable. These are all the liabilities. And the owner's equity reflects the ownership stake of the company's shareholders. And it also includes the retained earnings. After that, we move to the retained earnings. That what are these? In different companies, they have different retained earnings in the beginning. Like if a company have 40 to 50,000 in the form of retained earnings, then they add up their net income. If they have profits of the company, then they add this into the retained earnings. And then different dividends which are paid by the company to their shareholders, like preferred shareholders and common shareholders. It gives us the ending balance of different periods that we are going to determine the retained earnings of that period. It gives us the ending balance, and then we discuss the disclosure of financial information. This disclosure of financial informations is being made in different forms like the footnotes, management discussion and analysis, and auditor reports. So the footnotes provide the additional details and explanations for items presented in the financial statements. Like the financial statements are recorded at some date, and before the publishing of these financial statements, if some major activities or transactions are being made, then the footnotes are being prepared to address the investors and stakeholders of the company that these major transactions are being made during this time. And then there is management discussion and analysis, which offers the insights into the company's performance plans and future prospects. And then there is the auditor's report. Auditors determine that to which extent these reports are fair and providing transparency. These auditors express their opinions on the fairness of these financial statements. Then we move to the closing entries for revenue accounts. The closing entries of the revenue accounts are being made in this form that the revenue accounts are being debited to reduce their balances to zero, and these are then credited to the income account for the transfer of revenue accounts. For example, we determine that we have a revenue of 50,000, then it will be debited to balance the revenue account to zero, and then this 50,000 will be credited into the income summary. And in this form, the revenue accounts will be closed. And then these closing entries for expense accounts. So for closing the expense accounts, the expenses are credited to reduce their balances to zero, and these expenses are then debited into the summary account to transfer these expense accounts. There are different kind of expenses being made in the operating the different activities like cost of goods sold, wages expense, salaries expense, different bills. These are all firstly credited to reduce their balances to zero, and then this amount is being debited into the income summary. So for closing the entries for income summary and dividends, income summaries which are being prepared by crediting the revenue accounts and by debiting the expense accounts. Then we transfer the net income that we have received or the losses in the if the expenses are more than the revenue, then there will be the expense loss in the company. These are then moved to the retained earnings account, and retained earnings show that how much profit or how much loss they have made this year as it and then we move to the closing entries for dividend accounts. The retained earnings account to there will be a debit to the retained earning accounts to decrease the balance, and there will be credit in the dividends account to reflect the distribution of earnings that we have made. So this is all from this chapter, and